Another big thing that you need to know when you're starting out, trying to get ahead is what does a bank look for when you go and say, hey, I want to buy a house, right? Like, how do you get approved for a mortgage? And one of the things that comes into play is something called CMHC mortgage loan insurance. I know it's cut off a bit here, but you can Google CMHC in Canada. And basically, this is an insurance to the bank so that they'll lend you more money than they would normally. Because normally they only lend you 80% of the value of the home you're buying, meaning you need a 20% down payment. This lets you buy a place with 5% down. Here's how it works. If you're buying something that's under 500,000, you need to have 5% down. If it's above 500,000 to $1 million, you need 10% down on the next 500,000. And if you're buying something that's over $1 million, you can't get this at all. So you need to have 20% down or go through a different insurer. But this one, we're talking about the main one in Canada called CMHC. Now, they say that your gross debt service, so how you figure this out, take what you make per year, divide it by 12, okay? And then take how much your costs are for maintaining a home. So this includes whatever your mortgage payment will be. But the long story short is that all of the costs to service having a home can only be 32% of what your gross income is per year divided by 12. This is called your gross debt service. The other one is all your debts combined, because like a credit card isn't required for servicing your house or a car loan, right? When you add up all of those payments, that can only be 40% of your gross household income. Now you see how there's little stars there beside the percentages points? This is why. When you go to the professional side of this site and you bring up the PDF on how the insurance works, you can see here the GDS and the TDS. So this is gross debt service. That's how much it costs for you to have a house. Total debt service is all your debts combined. It can actually be 39 and 44. Okay. And then up here, it actually says your minimum credit score can be 600. So depending on who you go to, and let's say you get denied going to your local bank, there is some leeway in terms of the general, 32% gross debt servicing, 40% total debt servicing if you're using CMHC insurance. You can also take away from this that if you lived in a place like maybe Alberta, which has a lower entry point for buying something, you can get a lot more home and still have CMHC insurance. The other big thing is that this costs money. So essentially, you buy a house with 5% down. After this is all said and done and added onto your mortgage cost, you'll have like 1% equity in the home. Okay? But this is how it works.